sir, recording start kar dijiye.
Started.
Okay, thank you.
Okay. So yeah. Firstly, a very good evening to one and all present here. On behalf of the JGU Investment Society, it gives me immense pleasure to welcome you all to today's webinar on the fundamentals of personal finance. I'm Arnav Danan, the events committee head of the society, and I would be your host for the day. A wise man once said, and I quote, "When prosperity comes, do not use all of it." In today's modern age, where money has gradually grown to become an indispensable instrument to lead a happy or a secure life, it has become all the more important for an individual to know how to manage personal finances. This would usually entail decisions regarding savings, investments, and budget. I'm sure none of us would want to constantly worry about money once we graduate and start working, right? However, according to a report by the American Psychological Association, an estimated 64% adults claim money to be a major source of stress in their lives. Now, as scary as that may sound, at the end of the day, it all comes down to the fact that when it comes to your finances, you're in the driver's seat, and it is your decisions and your choices that ultimately affect your quality of life. To help us along this journey to take control over our personal finances, I'd like to welcome Mr. Ankit Agrawal, who is the co-founder of an upcoming fintech startup, BeFinSavvy. Now, Mr. Agrawal himself has had to go through several challenges and commit mistakes to finally know how to manage money and acquire financial freedom. So without much further ado, I believe we can begin our webinar and would like to hand it over to Mr. Agrawal to continue the proceedings. We certainly look forward to hearing your words of wisdom, sir. Also, as a disclaimer for the participants in the meeting, this would be an interactive webinar. So do feel free to pose in your questions throughout the course of the webinar in the Q&A option that you have on your screens. And I'm sure Mr. Ankit would be glad to answer your questions. Thank you.
Sure. Thanks, Arnav. Medha, would you like to start?
Yeah. So thanks, Arnav. That was actually the perfect introduction, I can say, because you kind of have set us off on the exact foot, which actually saves us a lot of trouble as well, right? So the expectation is perfect, and that's kind of why we're here today, is to understand, okay, how can we live a happy life and make sure that money is not a cause of stress in our lives. Now, firstly, are you able to see the slides? Yeah. Okay, perfect. So let me start off by just reiterating some of the things you said. This session is going to become super meaningful depending on the conversations that we have, right? So do ask questions. From time to time, I'm going to ask you to raise your hand. So do feel free to do that, and then we'll unmute you so you can share your thoughts. Feel free to take screenshots. So we won't be sharing the slides, but you can take screenshots. I've also given our handles here. So if you do share them with people, do tag us. And I just want to say it is up to you to make the most of the next 30 to 45 minutes. And I really look forward to the conversation. Thank you for having us. I just wanted to thank Arnav, Artham, and JGU Investment Society for inviting us as well. Okay, so Ankit, over to you.
Thanks. Okay, all right, let's start by asking, what do you guys think about this image? What do you think it represents? Anyone who wants to speak, please raise your hand and we'll unmute you. Or they can also put it in chat, right, Medha?
Yeah, they can. They can also actually put it in the chat.
Oh. Okay, so I can't see who's raised their hands.
Okay, so I don't see any hands raised. So Artham, let me put you on the spot. What do you think this is, or this represents?
Right. It definitely looks like a cup. I don't know in terms of finance what it would mean, but it looks like a cup.
Okay, so generally speaking, this is how broadly how the journey looks like whenever you are thinking of, or trying to learn something. You start from a point, you make some progress, you hit some challenges, you go through the learning curve, and then you come out on the other side winning. And the journey towards financial freedom is also quite similar. So when you start making progress, you will be facing challenges. Okay, and we are here. We want to, just explore ways how we can make this journey, fast track it, so that you avoid expensive financial mistakes and soon reach your financial freedom or retirement sooner. Okay, so quickly introducing myself. I'm an engineer from BITS Pilani, and in the second year of my college, I got interested into finance. So I took a few courses in finance, and my dream was to become an investment banker on Wall Street. So soon after college, I joined as an investment banker with Swiss Bank UBS in India, and then I was transferred to New York office. And over there, I was able to live my dream, being in the boardroom with CEOs and CFOs of Fortune 500 companies, and being a part of the decision making for like billion-dollar transactions and all. So this was a different kind of high. But this is on the professional journey. On the personal side, when I started working, I knew keeping money idle in your bank account is kind of you're burning its value. So I wanted to invest my savings from early on. So I started, just Googling, okay, how is it that I can invest my money, and or just, be better in terms of managing my money. And the advice that I got from, just Google, that was too generic. The advice that my friends and family were giving, they were more aligned to their own financial personality, not as much my own. So when I took their advice and, used Google, many times I had taken losses. So I was like, okay, it can't be this random. So I was like, okay, so in order to get or learn some structure how you should be managing your overall money better, I started learning, and then I aligned my learning and my decisions to my risk profile and what I want to do in terms of my financial goal. So I followed this, and after working for a few years in New York, I was able to retire at the age of 29. And if I can go back in time and teach my younger self what we are about to discuss today, I would have been able to retire earlier, younger than when I was 29. So after retiring, I came back to India and I wanted to start my own venture. And I love finance. I love making money, both for myself and like others. So it was sort of a no-brainer for me to start something in finance. And that is how BeFinSavvy was born. So at BeFinSavvy, our vision is a world where professionals take smart financial decisions and achieve their financial freedom at the earliest. And this can happen, when you're able to avoid those mistakes. So since we are talking about financial freedom and financial goals, so let's start with asking people if they have financial goals. If you can share any financial goal you have. Again, feel free to raise your hand and we'll unmute you, or if you want, you can also type it in the chat. Retiring early, okay. Trishna is saying retiring early. Living in a big house. All right. Okay. Any raised hands, Medha? Studying abroad?
No, I don't see any raised hands.
Okay. Traveling around the world. Okay, great. Able to travel the world. Okay. Cool. Settling abroad. All right. Being able to afford sabbatical. All right. Okay, so this is all good. Now, when we say financial goal, there are three elements to a financial goal. First of all, an event in the future. Okay. Then next is a monetary value attached to it. And third is the time frame in which you want to achieve. So saying that I want to buy a house, like when, it's like someday kind of thing, right? So it's too vague. So it's not really a financial goal. But saying that, okay, I want to buy a 3 BHK for 1 crore, say in 3 years. Okay, obviously these are broad numbers. Things won't be exactly the same or exactly at these points. But broadly speaking, this becomes a financial goal. Saying that I want to retire early, that is not a financial goal. Saying that, okay, I want to retire with 2 lakh rupees per month of financial, passive income, like in 10 years time. That is when you have defined a financial goal properly. Okay, and now that we have some clarity about what a financial goal are, and we have been able to identify, the next step will be, how is it that we can achieve it? So our philosophy of for managing money is step up. Okay, it means that set your taxes, expenses, your portfolio in alignment with your ultimate purpose. Okay, so we talked about goals, right? That, okay, so someone wants to buy a house, someone wants to settle abroad, someone wants to travel and retiring early. So, okay, so we understood the goals side of it. Okay, but as you see in this photo here, in the image on the right side, these goals are steps towards achieving your ultimate purpose. Ultimate purpose, I'll tell you what it means, but what do you think? I mean, again, guesses, guys. What do you think your ultimate purpose in life is? If money is not a factor, you don't need to worry about that. It's taken care of. You have retired. What is your ultimate purpose? Happiness. Very good. So Tejas, how do you think that you will achieve happiness? What is happiness for you? I think all of us want to be happy, but our definition will be different. Artham, Arnav, you guys can also come, participate. Carefree life. Okay.
I think for me, it would actually be, when I grow older, to be able to provide for my family and a bit for myself, of course, to make sure that everyone around me is doing well, to be able to make the world a better place as well, maybe.
Okay, very well put. Okay, great. So what you guys are saying, that is what ultimate purpose is. So if you want to buy a house, or study abroad, or retire early, whatever it means for you, after that, what you're trying to do, that is your ultimate purpose. For someone, is like just spending time with our family and just giving quality time to people. For someone, it may be that, okay, I have retired. It's like, for me, it was like, I want to retire so that I can work on something that I want. I want to start my own venture. Okay, so that was my thing. For someone, it can be setting up a foundation so that they can do more of social work. Okay, for someone, it may be, yeah, okay, now I've retired, I've done worked so hard and put myself in a position where I'm very comfortable. I would like to just travel the world, just experience the different cultures, interact with people and whatnot. So whatever that ultimate purpose is, these goals are going to take you to that ultimate purpose. Okay. Now, your goals will be powered by this simple equation. So this is an equation, or this is how the money flows for all salary people. You have a salary or package or gross pay, whatever you may call it. From there, you get some taxes and certain other deductions taken off. After that, you get net pay that comes to your bank account. From that amount of money, you start making expenses. And then, of course, you have got savings and investments. So it is important, like extremely important, that all three of these points are working towards your financial goals. All three of them should be aligned properly. Okay. And after understanding the philosophy, let's talk about what is the exact steps we'll be taking to implement this. Okay, so we have come up with this term, sale coin. Just a simple mnemonic so that we can remember. S is for savings, A is for accounts, L is for liquidity, E is for emergency, CO is for coverage, IN is for investments. Okay, now we'll be looking at each of them in detail. So savings, obviously, your expenses should be lower than your income, right? And so in a recent survey, it was found that 80% of single Indians are saving less than 10% of their monthly income. And that is a shocking revelation, shocking data. Okay. See, when it comes to you guys, it's like you guys are from a good college, and then you would probably be starting with a good salary. And to start with, you guys will not have a lot of responsibilities either. Okay, but a mistake that a lot of people make, particularly in early in their career, is blowing out all their income. It is extremely important to enjoy your life, and we are all about balance. We always propose or suggest our clients to maintain a balance. Enjoy your life, and just also think about how you can start planning for the future as well. Okay, and when it comes to retiring early, it's not about how much money you're making. It's about how much you're saving and how you're managing it. Because I'm sure, I mean, all of us have heard of stories wherein celebrities making millions of dollars per month, and even after that they go bankrupt, right? So it is extremely important how you're managing your money. Okay, and particularly for you guys, the 50-30-20 rule will not be applicable to most of you. Okay, have you guys heard of this 50-30-20 rule? Anyone? Yes, someone said yes. Okay, so can one of you please explain quickly, mention what it is? I know that you guys are chatting. Yeah, exactly, Trishna. So 50 for spending, 50% of your income for spending, 30%. Okay, no, sorry, Trishna, spending is for spending on needs is 50%, on your wants is 30%, and 20% is on your savings. Okay, now this is something that this rule, you can say, was made popular by Elizabeth Warren, Senator Elizabeth Warren in the US, and it is more applicable for someone who is just kind of managing, just surviving, sort of. People like you who would probably most likely be, getting better jobs. You shouldn't be thinking it from the perspective of 20% is what I should be saving. Particularly now, when your responsibilities are going to be lower, you should be allocating a higher, percentage to it. The number, what exactly a number should be, it varies from person to person, their situation, their responsibilities, but it should definitely be higher than 20, unless there are certain, specific cases. Next is A. A is for accounts. So when you start working, you should have 2 bank accounts. First one is where you get your salary and from where you make all your expenses. Okay, and the second one is for your savings and investment. So say first of the month, second of the month, whenever you get your salary, soon after that, you should be transferring a fixed amount every month to your savings cum investments account. So that money is out of sight, out of mind. That money is not meant to be spent. That money is your savings. And from that account, the second account that you have, from that, you will be making investments. Okay. Next one. So guys, are we good here? Midha, any questions so far?
No questions.
All right, cool. Okay, so next one is L. L stands for liquidity. So you should have at least 1.5 to 2 months of your monthly expenses in your bank account. Okay, your expense bank account. Just in case, something comes up, you need to make certain expenses, that amount should be there. You can consider this one just for, certain expenses, small little expenses that are coming in. And because obviously, from time to time, there will be certain variable expenses will be there. So you can just take care of that. But in order to do this, you first of all need to understand what your expenses are, because 1.5 to 2 months of your expenses, right? So it's extremely important, very, very important that you track your expenses properly. And so we are actually in the process of launching an app wherein you will be able to do this extremely easily. And it would be in a beta phase initially. And if any one of you would like to, be a user for beta testing, Mida has shared a link. Feel free to join the waitlist. And as soon as we have launched the app, we will invite you to, experience it. So this is the L part, the liquidity part. Next one is emergency. Emergency, as the name suggests, is for emergency purpose. So if you're thinking of buying the next iPhone or thinking of going for a weekend trip somewhere with your friends, that doesn't really count as an emergency. Okay, so there's, say, a medical emergency, or just if you want to take a break from work, just to find a better opportunity, just to think about, what is it that you want to pursue next, or something like that, you need to have an emergency fund. And this emergency fund should be at least 6 months of your expenses, 6 months of your monthly expenses, and ideally 12 months of your monthly expenses. And so what do you do with this? You put this in fixed deposit, but short-term fixed deposit, not very long, not like 5 years, 7 years, kind of thing. Something like 6 months, 1 year is, a decent time frame. You can also call this fund to be, for something that you can get a good night's sleep, so that you don't have to worry. If something happens tomorrow, there is a special dedicated fund that you have created that can take care of any emergency last minute thing that can come up. Okay, so this is the emergency fund. Next one is CO. CO stands for coverage, insurance coverage. So when you're working for, particularly for like when you're working for big companies, you will have, Artham, you want to say something?
Yeah, Ankit, just about the last slide, actually, you said that ideally we should put the emergency fund, the monthly expenses into a fixed deposit. I was just wondering, why exactly a fixed deposit? Why not, maybe like an ETF or a mutual fund for maybe the same amount of time, which could give better returns as well?
So when you, okay, so this fund is something that you should be able to tap into really easily. Like if I need this money at say 11 p.m., I should be able to get it at 11 p.m. Okay, if you're investing in ETF or any other instrument in the market, first of all, there can be a volatility. So you never know that if you have, say, if you have put in 5 lakhs, if at that moment, if it is 5 lakhs, that 5 lakhs is 7 lakhs, or if it is 4.5 lakhs, you never know that, right? So you need to have it, you need to put it somewhere that it is extremely easily available, very easily. And secondly, the other thing is that it shouldn't be volatile. Okay, it should give you a decent return, not putting it in your like savings account because the interest rate will be low. You can go for, so it's a risk-free investment. No risk is involved. The value of your investment, the initial principal amount that you have invested, it will just slowly only, but will keep going up. Okay.
All right. Got it.
And I think someone also suggested liquid funds. Liquid funds is also good to have, but they also have, so in stock market, the settlement is T+3. T+3 means if I'm placing an order today to sell my funds or any investment, it takes 3 business days for the money to come to my bank account. And emergency fund is something not that you can really afford to wait for, 3 days, or it may also be 5 days if a weekend is involved. Okay, but sure, if you want to be, just be more creative with it, and if you have some more room in terms of buffer, you can definitely try to put some amount in liquid funds as well. Okay, Artham, does that answer your question?
Yeah, thanks a lot.
Cool, sure. Okay, so next one is coverage. So when you're working for a relatively big company, you will be getting health insurance and a life insurance from your company. Health insurance is something that, so when you join, you just need to finish up a few paperwork so that the policy is in place. You don't need to pay for anything for that. But make sure that after you have gotten that policy, the paperwork is done, the policy will be issued to you. It may take up to a week's time, but then you get a policy card. It's broad, so it's on paper, so it's a soft copy, and broadly the size is of a credit card, you can say. Make sure that you take a print of it, a hard copy, and put it in your wallet. If you want, you can get it laminated, because God forbid, if something happens and if you're somewhere and you need to be admitted, that card is there, so that even if a stranger is there and he's taking you to the hospital or something, you're taken care of. Okay, and it has emergency number so that the right people can be contacted and everything. In terms of life insurance, generally companies don't give a lot. The coverage is not a lot, it's just a basic amount. But if you have dependents, that means if there are people who are depending on your income, be it your parents or you have a family, kids, so it's extremely important that you have a life insurance. People do not give enough importance to this, but it's very, very important that you have a life insurance. But it's also very important that you're very careful in terms of buying a life insurance, because in the market there are a number of really bad products. Okay, yes, Daksh, term insurance is pretty good. Okay, but there are a number of other policies, and when a broker is trying to sell it to you, they will try to sell you the policy in which they make more money, best commission, and it may or may not be good for you. So, and there is a huge amount of mis-selling that is happening in the market. So be careful about it. Okay. Now, after you have done these steps, that is when you're ready to make investments. Okay. Once you have all of these things taken into place, then that is the time when you can think about designing your portfolio and making investments. Okay. Now, in order to develop your investment portfolio, or how you're going to make the investment, there are 2 things that you need to know. First is your own risk profile. How much risk you are comfortable taking. And this is not, this doesn't translate from your, social life. So if you're able to, lift a lot of weight in the gym, or if you are very aggressive when it comes to, say, sports or any other aspect of your social life, it doesn't, the aggression that you have in social life doesn't really translate directly into the financial life. So you should, so we have developed a risk profile. That's a free tool over there. Sumita, please share the link in the chat, so that you can go over there, just answer a few questions. It will take hardly like 3-4 minutes, and you'll get your the result in your on your email. Okay, with this you can understand how much risk you can take, and that can help you. It's going to be instrumental in designing and developing your portfolio. Okay, the next thing that is also very important. So there are two aspects actually when you're developing your portfolio. First is your risk profile. The second one is your financial goal. Okay, so if there is a goal that is relatively short term, the kind of investments that you're going to make is going to be different. You can't take a lot of risk because you need money relatively soon, right? But if you have a longer term goal, you can take more risk. But how much risk is something that is determined by your risk profile. Okay, so feel free to check this out. And but yeah, when you're making investments, okay, as I was saying earlier, it is very important that you select the right products. Okay, and so over here we have got a few of the mistakes that you should avoid and how to avoid them. Mitha? Yeah, so the first one is get professional help. So once you start working, do not hesitate in talking to an expert, a professional who can guide you and develop a financial profile for you, financial plan for you. Okay, traditionally this service was sort of reserved for the ultra high net worth people, because these advisors who could actually just watch out for you, they used to charge a lot of fees that most of the people are not in a position to afford. The fees itself is into lakhs. Okay, but now a lot of companies are coming up who can guide people who are from the mid segment as well, like middle class and upper middle class. We also help people with developing their plan. So if needed, of course, you can reach out to us as well. The next one is follow the money. Like, say, if someone is coming to your office or your home and saying, sir, you should definitely buy this product, or ma'am, you should definitely go for this insurance or mutual fund. And if that person is not charging you anything, think, how is it that he's making money? If he's coming to your house, spending, I don't know, half an hour, 1 hour, just explaining products to you that, okay, you should go for this and that. How is it, or how is it that he's making money? It's extremely important to know that. Because we had a client. She was making mutual fund investments through one of the investment platforms, and when she took consultation, so I told her that, okay, so you should move away from this platform from A platform to B platform. I mentioned to her. So she was like, Ankit, but why do I need to do that? I mean, this platform is anyways giving me a decent experience and everything. So I was like, hey, but these guys are charging you a lot of hidden fees. I don't think there is any fees, but let me check and get back to you. I was like, sure. So she got back to me, and then she said, Ankit, I read, and they said that they are not charging me anything. They just charge a small fees to the mutual fund company. That's the asset management company. So I was like, okay, so the asset management company is in the business to make money, right? And if they are paying this person, this platform on your behalf, essentially that money is coming out of your own pocket. The money that you have invested, say 5 lakh rupees is what you gave the asset management company or the mutual fund guys to manage. From that 5 lakhs, a portion is going to this person, because there are no free lunches, right? So just understand where the motive is, because otherwise you will, just to avoid upfront fees, you may end up with really bad products. So it's extremely important, again, to look and find the right product. And the next one, and this is a biggie, guys, and it is tricky as well. Be aware of half-baked knowledge. I'm sure you guys must have heard about little knowledge is a dangerous thing, right? So particularly for people who are coming from finance, or people who have done some research online and just gather some information, okay, they think that, yeah, I understand stuff, but that may or may not be true. Okay, so we had another lead, and she shared her number with us, her details, and we proposed that, okay, we'll be able to save approximately 1.3 lakh rupees in taxes for you. And so she got back to us and she said that, okay, I've selected these. So I did my research, and then I'm able to save approximately 1.3 lakhs based on certain products that I've selected. These are the products. And so will you be, I mean, I'm willing to take your, I'm willing to pay for your service if you're able to save, if you can save me more money. The thing was that that was the maximum that she could save. But so we could not help you save more, couldn't say help us save more money. But when it comes to deciding the products, she was going for really bad products for which she will be stuck for a really long time. Okay, so if you are, particularly if you're, so okay, so I have worked for my almost all my life in finance, and even today I can't say that I know everything about finance, because first of all, finance is huge, and the second, that the landscape keeps evolving, the rules keep changing, new products keep coming. So in order to keep abreast for a full-time worker, for someone who has a full-time job, it is difficult. And even when I was working, I did not know everything. And now that we are running this startup, BeFinSavvy, we are focused more about finding these details out of what's happening, what's going on under the sheets. That is why we have a better understanding of that, and that is, of course, I'm using and making my portfolio better, almost trying to make it better every moment I can get. So yeah, these are the few of the mistakes that you should be aware of. And BeFinSavvy helps you, it acts as a bridge and helps you avoid the frustration that comes with, when you have made some costly mistakes, expensive financial mistakes, and you're stuck with those. This is what we help with, and we offer personal finance consultation, and we also do spread financial literacy online as well as through these workshops. So coming back to the investment part. So here are some of the assets that I'm sure you guys have come across, and these are the standard out there: cash, fixed deposit, shares, bonds, mutual funds, crypto, real estate. But now we'll be looking at how is it that we can, as an example, how we can come up with a strategy so that if someone is wanting to invest for a certain purpose, how is that he can go about. So let's take an example of Karan. Karan wants to buy a 3 BHK in 5 years' time, and he thinks that his dream house will cost 1 crore rupees all in, and he only has 5 lakh rupees in savings today. He's thinking that he'll take approximately 80% in loans, so he needs to have 20 lakhs in 5 years' time. So he has 5 years today, and he needs to additionally earn, or earn through return or savings, additional 15 lakh rupees in 5 years, and he's a medium risk taker. So let's keep it simple, and let's consider that there are only 2 options for him to invest. First is in shares. Second one is in fixed deposit. So what he can do is he can divide his money 50-50 in shares and fixed deposit. So he can keep it like this for 3 years, and after that he can slowly start moving his funds from shares to fixed deposit, so that by the time he needs the money, everything is in fixed deposit, so there is no risk or volatility involved in his assets. So you can be sure that, okay, by the time I need the money, all of it will be in my bank account, safe and sound. Okay. So, but by the way, do not try to copy this. This is just for representation purpose. It is not something that you should be using. Okay. All right. So with this, with this, we come to the conclusion of the presentation. And Midha, will you like to take it over from here?
Yeah, so basically, these are the kind of steps that you should be taking when you're starting to think about your finances from a long-term perspective. I just want to now hear from you guys. If you have any questions, you can raise your hands or type them out so we can answer them. Yeah. And Artham as well. If you have any questions, you can just unmute and let us know.
Ankit is a question. Daksh is a question. He says FD does not beat inflation rates, so why would you recommend someone to put money in FDs?
Good question. So we're not asking you to put all your money in FD. And before you can go for riskier investment, it is also important to be sure that you have built yourself a cushion, that if you need something urgently, you have access to it. So if you go purely by just by the returns that it can make, an investment can make, you can also go for something which is very speculative asset, be it crypto or investing in small size companies. Okay, but again, that for those is going to be very high. You may be able to make return in the longer run, but if you need money immediately, those investments are not going to help you. Okay, so that is why it is important that you have certain amount of money in your fixed deposit, or something that is very easily accessible, and after that then you can go for investments that make higher returns. Yeah, there's many other investment options available in the market. So Daksh, I am not understanding the question completely. So of course there are a number of options that you can explore, but the point was that before you're making investments, it is important that you have few basics right. Yeah, so Daksh, I actually already clarified about ETF and liquid funds. I answered those questions.
Ankit, I wanted to ask, based on my own experience. So I started investing in the stock market in around October, and of course, so last October, and of course, it was not my own money, from my father's money, from my pocket money, whatever. But I realized that, of course, that was a very small, limited amount. So as students who aren't really earning ourselves, how do you think we can maybe get more capital from somewhere to invest, or what investing strategy possibly could we use where we have small investment amount but with high return, and then we reinvest? So just something along those lines, if you could tell us about.
Sure. So Artham, in terms of when you're investing, first thing again will be like, what is your goal? Are you investing for the long term, like from the perspective of okay, so this particular investment will be from the perspective of from a retirement, or you're thinking that okay, so when I'm going to complete my studies, I will be probably moving to a new city, right? So when I'm joining joining my job in a new city, there'll be certain initial expenses that are there that needs to be taken care of, and I would like to be in a position where I don't need to ask my parents, right? So from that perspective, if it is anything, I mean, when you're starting to invest, or when you're investing the money, and the point of time where you need to withdraw it, if it is a short term, say 1.5 years time frame, going for debt funds is something that is better. Okay. Low risk, consistent income. Okay, small income but consistent income. Your money can keep growing. If you're serious about that, okay, I want to. So if I've invested, say 5,000, 10,000, whatever the amount is, if I've invested this amount and I would like to use this amount to, when I'm going to join the company, right? If you have got longer time frame, like for people who are who are studying, and it's 3 years, 4 years, 5 years time frame is there, then they can definitely go for something which is more slightly on the higher risk, which is like, you can go for equity, or if you want to make speculative investments as well, part of it can also go for crypto. But okay, crypto is something that we generally ask people not to invest in. Of course, it has given good returns, but again, the volatility is there, and the ways how you build or invest in crypto. Crypto is one of the most speculative assets, and you assign a very small percentage of your total portfolio to that. But apart from that, generally speaking, it should be the more traditional asset classes that should be there. Again, take if you're trying to do that, if you want to do that, take this take this risk profile test. Okay, it's just a few questions. You would understand what's your profile, because so that if what happens in the market tomorrow, no one can predict. If the market goes south tomorrow, you should know what kind of person you are and how you'd be reacting to it. Okay, so this is going to help you in just allocating your resources or allocating your funds in various categories. How you should be doing it. Okay, does that answer your question?
Yeah, definitely. Yeah, thank you.
Sure. What is the name? What is the meaning of the name of your startup? Okay, Sanav. And also, what's the long-term vision of BeFinSavvy in fintech space? Okay, Sanav. So BeFinSavvy stands for Be Financially Savvy. This is what we want, this is what we are trying to achieve, or our vision is for our clients. And as I mentioned in our presentation, our vision is a place where professionals are able to make smart financial decisions so that they don't get stuck in bad products. And there are products where if you buy something, you may get stuck for 10 years, 15 years. And if you want to stop it, you need to pay really heavy penalty. So we have seen so many of our clients having products like that, and we don't want people to get stuck in such products. So making smarter financial decisions so that you can achieve your financial goals and your financial freedom sooner. Prithvi, hi, could you suggest books or YouTube channel for beginner in finance? So Prithvi, can you clarify in terms of beginners in finance? Are you talking about beginners in terms of personal finance, or are you asking for investment? Megha Sharma, thank you for engaging session. What reliable resources will you recommend for students in order to further learn about personal finance and investments? Okay, so for personal finance, there are a few books you would have heard about. Rich Dad Poor Dad is, of course, one of the most famous books. There is another book, a very easy read. The name of the book is Richest Man in Babylon. It's kind of kids book, you can say a children's story kind of thing, but it was written something like in 1920 or something, 1920s, but still relevant today. Another book, just to understand or your behavior about money, is a relatively new book, is The Psychology of Money from Morgan Housel. Again, a very, very, very good book. Okay. In terms of investments, yes, in terms of investment, you can go for, what should I suggest? First of all, you need to understand, the basics of what the various asset classes are. Okay, a good place to start will be, our own social media page. We start from covering, very basics and explaining all the different types of asset classes that are there, risk involved, kind of potential returns that you can make. Those things are already covered. And apart from that, in terms of channel, I don't think I'll be able to, nothing's coming off my top of my mind. But Megha, I'll share something with you. Okay. Yeah, Prithvi, I just mentioned these. Sure. Any other question? Sure, Prithvi. Okay, guys, do we have any other questions? Or thanks for your time, Ayush. Appreciated that you attended. All right then, Megha.
Yeah, I'll hand it back over to Arnav and Artham.
All right. First of all, I would like to thank everyone who joined in the session today. We understand it's a Saturday and you gave your time, so thank you for that. I'd like to thank Ankit and Medha, of course, from BeFinSavvy for being here, for teaching all of us valuable lessons on personal finance and investing. I'm sure all of us have by the end of this 1 hour session, we've learned something new. So I'd like to thank you for that. And again, if there are any more questions, please let us know in the chat. Otherwise, Ankit and Medha, I'm sure you can leave your emails or whatever contacts for BeFinSavvy where people can reach out to you. So that would be great. Otherwise, I think we're done here. Thank you so much, everyone, for your time and for joining.
Thanks, Artham. Thanks, Arnav. This was a great session. So much, guys. Thanks for the participation, guys. Appreciate it. So here's Medha's email ID, and we are also very active on Instagram and all. So feel free to drop any questions that you have on Instagram. We'll be happy to answer. Okay, thank you, guys. Bye-bye.
Thank you. Bye.
Ajay, sir, you can stop the recording.